and been part of, in terms of strategy level, board level, I've seen where people who got it right benefited tremendously from the partners and the corporate governance structure that they had. And then people who got it wrong, that was the reason the business failed. Not because the business didn't have a product or that the people in the business, which is the HR, like the people on the field were not good, but because governance wasn't set up properly. And so there was no proper management of the business. So today, I have the pleasure of talking to Lovetta Kesua Doche Ajumandoche. Yes, one of them. So, Lovey, if you are online, please kindly turn on the video and then we can begin. Whilst we are waiting for her to join, I would like to remind you that you are on PBI today, the People Building Institute, and we are still on our What is Wrong series. We've gone through business setup, business innovation and setup, business idea creation with Ecomensa, and then we now went into operations management with Ed Cyprian. That was the last one that we've had, and we are now currently on corporate governance. From corporate governance, we'll be moving into the money finance, but for now, we will be talking about corporate governance, because if your corporate governance is not right, even if your business idea is great, even if your operation strategy is fantastic, if the corporate governance is not right, the business could fold. So, ladies and gentlemen, let's just give 2 seconds for Kesua to join in and we will begin.
Hi, I'm here.
Hello. And you've been leaving me to talk. I've been talking because I couldn't see your face.
I'd like to hear you talk. I like to hear you talk. And I like everything you were saying. I mean, so true, Elida. So true. Yeah.
Thank you. So we have the endorsement from the expert. She's already said the things I said are true. So so yeah. Before we start, I just want to get to know who you are. So if you could tell us about your skill set and then your work experience in relation to the topic we're discussing today.
Okay. So, like Elena mentioned, my name is Lovetta. I'm a corporate governance practitioner. I've been doing this for almost 5 years now. It's my passion. I love to do it. Like she said, that if a business would go well, then it's because the governance structure is right. But if it falls, then it means that something was wrong there. So I absolutely love doing this. I'm a company secretary for a number of boards. By that, I mean that I offer governance advice to a number of boards locally, internationally, and I've seen the progress it's given them so far. So I'd love to share my knowledge with you. That's why I'm here.
Thank you so much. I'm going to dive straight in because even though a lot of people like to think of corporate governance after, like, maybe when they're applying for a grant or they're going for funding, then they want to think about corporate governance. I believe it is one of the discussions you should have in the business idea creation stage. So what types of business vessels do we have in general, but then specifically in Ghana, what kind of business vessels do we have in terms of what businesses can an entrepreneur or a group of entrepreneurs open?
Okay, all right, that's great. So like you were saying, specifically in Ghana, because every jurisdiction has their business structures or options that entrepreneurs could go for. But home in Ghana, there are the sole proprietorships. That's the one-man business, as some call it. There are also the incorporated entities. Incorporated entities could either be companies or NGOs. The difference is that one is limited by shares and the other is limited by guarantee. And there are also partnerships as well. And these are quite the common ones that we have in Ghana now. The most common, of course, would be the sole proprietorship, followed by the incorporated entities.
Okay, thank you. Because I have heard about this and I've seen this also in one of the discussions I've had. Special purpose vehicles, are they a business or what are they?
So special purpose vehicles, SPVs. So if you hear me say SPVs, that's what I mean. They could be incorporated as a company, as limited by shares, right? But they are incorporated purposely for a particular maybe to implement a project. Usually they are for projects like that, where you have maybe a private partner and a public partner come together, and then they they establish this business or incorporate this company for a project. Then post-project, the business is dissolved.
Oh, okay. So if I recap, we have the sole proprietorship, which is one person, and then the limited liability, which is different entities, and it could be limited, or can it be one person owned by one person?
Yes. Okay. So let me tell you the difference between the sole proprietors and then the registered companies or incorporated entities. So sole proprietors is simply registration of business name. That one, the law just leaves you to register a business name that is attached to yourself. So there is no separate identity from the personality or the person and then the business, right? So if, for instance, you take the registration of business name certificate, you see that the TIN tax identification number of the company is same as the individual who registered the business name. So the liability falls on the individual, right? But if you have an incorporated entity, then it means that you have registered a separate legal person, right? So what I mean by that is that the company is now an individual on its own, and you're an individual on its own. So the company is now liable for its debts. It has its own assets. It's a person, except that it's not human. So that's the difference. You get it, right?
Interesting. So with the sole proprietorship, can it have more than one proprietor?
No. So that's why it's called sole. And it's linked to the TIN. So the TIN is actually like the identification number of the sole proprietorship, the business. So it has the TIN of the individual. So you can't have two people having one business name or linked or anything of the sort.
Okay, so please, it's clear now. I'm going to ask all the questions you guys want to ask. I'm not going to talk as if I know anything. I'm going to ask all the questions. So sole proprietorship, one individual, you are the business. So basically, I'm going to ask her to go into it further, but you're responsible. You are responsible. Okay. And then limited liability, the business is its own person and you can have one or more people. Now, I want to go into the responsibilities of the owner of a sole proprietorship. What are the benefits of a sole proprietorship and what are the risks of the sole proprietorship?
Okay. So the first thing about sole proprietorship, I see that it's actually very common here in Ghana. And I think it's because very easy to register. The law is not quite stringent on them. And so they think that it's easy to have our way of a sort. Well, yeah, to some extent. But if you're really looking at going beyond a one-man business and you're looking at really having a bigger organization, then a time would come you'd have to move from sole proprietorship to a registered entity or a company. Because of the liability being tied to the person, the human person who founded the company, a lot of grants are not given to such organizations. They'd rather that you have an incorporated company where they believe that the company is treated differently. So the law really doesn't put so much of a responsibility on a sole proprietor. I think with the Companies Act or the Business Names Act, you have to just renew your business name annually. I think you also have some tax obligations that you also have to fulfill. But this is just really the legal obligation for a sole proprietor. That's it. Now, with a company, you're expected to, file annual returns. You need to have your audited financials annually. If you're in a quite regulated environment, you have to renew your licenses or you have to follow the, you have to follow the requirements of that industry as well. For instance, even before you incorporate, you have to have your board in place. With sole proprietorship, you're not forced, if I should use that word, to have your board in place. But with a company, you need to have your board in place. You can't have less than two. So it has to be two people aside the share. Well, the shareholders could be directors. We'll come to that. Let me not go ahead of myself. So you have to have that in place because you'll be required to provide information on them during incorporation. So 2 directors, one must ordinarily be resident in Ghana. You can't have both directors out of Ghana. Yes, so I've talked about the annual returns. You also have to have board meetings at least twice a year. You're expected to have your annual general meeting. So there is all of that. And this is just the Companies Act, which is more like foundational. But there could be other acts that apply depending on what your nature of business is.
Thank you, ladies and gentlemen. You're getting it. See, this is advice that you have to pay consultants for, but PBI is bringing it to you for free. Well, you have to use your data, but it's for free. You understand? So make sure that you're writing down and you're taking your notes, because this is going to continue for the next 3 weeks, and I want you to be equipped to ask the right questions. Okay? So if you're a business owner, a potential business owner, or you're a business manager, I hope you're listening to this, because this affects all chains in the business. Now, I want to go to the duties of the owners, the shareholders in a company. What are they supposed to do when they decide to come together? So, for instance, this is a business that has dual shareholders. I'm going to use two to keep it simple. So they have two shareholders. What is the responsibilities of these shareholders to the business and then to themselves?
Okay. Now, the funny thing about placing responsibility is that majority of it is placed on the directors of the company rather than the shareholders. However, the responsibility of the shareholders is that they appoint the right directors, right? So you see how it goes, that the directors are in charge of running the business, oversight. But then the shareholders appoint who the directors would be. That's the major thing. And then they are expected to meet annually. The annual general meetings for the shareholders to discuss matters and the progress or activities of the business within the previous year. That's mainly it. But mostly it is on the directors. Yes.
Okay.
So that's, yeah.
Okay. So we are starting from the top. You get it. The shareholders incorporate the business, then they appoint directors. And basically they give directors instructions on what they want to achieve. And that is why they have to meet every year in the annual general meeting to review whether the directors have been able to achieve. It's not, you don't have to meet compulsory only every year, but you must meet minimum once a year. Okay, you can decide to meet 5 times if you have time. But minimum once a year, you have to have an annual general meeting. Okay, so that's the shareholders. They've done their bit. They registered, they came together, had their idea, registered the business, appointed directors. What is the responsibility of the directors?
That is a lot.
So the basics.
So the law will tell you that the directors have fiduciary duty, right? And basically it means that the directors have the responsibility to make sure that the business is running, it's making profits, and it's not building on liabilities, right? So while you are taking care of the company, you're expected to meet. And so the law would say that you have to have 2 meetings. The law would also say that, 2 meetings in a year minimum. The law will also tell you that if any decision is wrongly taken, then the responsibility is placed on the directors. So I think the law is really particular about that wherever decisions are wrongly taken, it is placed on the directors. They are responsible or they are liable for the decisions that is taken, but not the shareholders. You get it? Yes.
Okay. So we've gotten to the director level. So remember that with the sole proprietor, there's one individual that registers a business name and is responsible for the business. Lovetta mentioned that your TIN, which is your tax identification number, is attached to the business. But with a limited liability company or a company, the TIN is assigned to the business. The business has its own TIN separate from the shareholders of the business. She also mentioned that the shareholders or shareholder of the business appoints the directors, and then the directors are responsible for running the business successfully and making sure that the business is not taking on too much liability, like she mentioned. So this is where we've gotten to so far. If you just joined, this is the best recap I can give you. You can try and watch the whole thing on YouTube when we upload it, but for now, this is where we are. So now I wanted to set this basis for everybody to understand, so that when we are talking about the what is wrong, they can pull from this to see to be able to understand the conversation and follow the conversation. So now, Lovetta, in the first episode of The What Is Wrong, I leave it to the panelist or the expert to tell us in terms of what they've seen in Ghana. Because I know because this is law, we have to stay in jurisdiction. So in terms of what you've seen in Ghana, what are some of the things that goes wrong with business governance in this country that brings potentially successful businesses down?
Okay. All right. So because I knew I was going to do this, I actually put down some diagrams because I'm going to present like 3 scenarios that I think are very common that I've seen, right? And then for each of these, we are going to together break down what the structure is and what could be wrong. Okay. So the first one, assume you have company ABC, right? And you have 2 shareholders. So they are sort of partners, shareholder 1, shareholder 2. Now, shareholder 1 is a director. Shareholder 2 is also a director. Shareholder 1 is also the CEO of the company. So now it's come down to employee. And then shareholder 2 is also the managing director. And then they have a general manager. Ellie, you see where it's going, right? I know from your experience, you have an idea. So now 2 individuals at the top, right from shareholding to director level to employee level, the same people. And then they just have a +1 who is a general manager. Now, even beneath general manager, there are heads of departments, right? About 3, assuming. And where we have the people in different departments, there is also a multiple role where they sort of play in 2 departments. Do you see? So there is this scenario. There is also another scenario where you have, say, let's say XYZ. Right, and then it's also 2 shareholders here, which is mostly the case, shareholder 1, shareholder 2. Shareholder 1 has majority shares, and the same shareholder 1 is on the board and is also chair of the board. And then shareholder 2 is the company secretary of the board. Then they have a +1 on the board, so it's third director. Shareholder 1, who is majority shareholder and board chair, is also chief executive officer. And then shareholder 2, who is company secretary, is chief operating officer. So there's this scenario. Confusion all over, right? So there's this scenario as well. Now, another very common one is the husband and wife business. Husband and wife shareholders. Husband and wife. They are also board chair and company secretary. And then they employ people randomly. They probably don't even have heads of departments running. All these 3 have some things in common. I know that Ellie is the one asking the questions, but from the reactions on her face, I'd rather want to ask this one. Ellie, what do you think could be wrong with these scenarios?
From past experience, and I'm not saying this from a book, I'm not saying this from what I've read, from past experience, accountability.
Exactly.
Is going to go to the dogs, because where you have shareholders separate from directors can't make excuses. But if I'm the shareholder and the director, I don't need to explain to myself. I know that the business is not going well. Instead of doing my best to make sure that by the time I go to the AGM, I don't go and give excuses. I just, you know what is going on. So for me, it's accountability. And then in the other scenario where majority shareholder was CEO and minority was COO, ego. When money enters, when they start making money, ego.
Yeah.
And I feel sorry for whoever is the company secretary in that majority or minority CEO and COO. It's going to be a very board meeting. And the husband and wife one, please, I don't have experience, but I can understand from what happens in individual businesses that, okay, when fight comes, you will see it in the company.
You know, that's where the board meeting becomes pillow talks. I mean, they would have the board meeting like 9 p.m. on their beds. And yeah, they've had a board meeting. What can you say?
So yes, do something and you're like, but who is giving this instruction? Excuse me.
Yeah,
Yes.
which actually happens. XYZ, my holder, might usually have when we see that partnerships do not really, if they don't have the right structure in place, they do not usually make it past a certain level, right? Now, mainly has to do with accountability, as she said. And then sometimes companies like this don't even hold their AGMs because there's nobody to report to. They report to themselves and they themselves are making the decisions. So now there is an overload of, should I say, interest of a particular stakeholder. What corporate governance does is that it gives every stakeholder of a company organization an equal share or an equal sort of equal attention, right? And by stakeholders, I mean shareholders, I mean management staff, the board, I mean regulators, even the environment within which you operate, your consumers, your suppliers, your agents, everybody's a stakeholder. If you have too much authority in one person, the person would take care of his interests first, even if he takes care of other people's interests. When that happens, assuming your shareholders usually are in for the, well, I don't want to put it like that, but because it's an investment for them, usually it's financial returns first. But you need, yes, but you need other people who are independent and probably have experience in the business. Maybe it's a fintech and they have a fintech experience. They don't have any monetary ties necessarily. They are not investors, but they know how a fintech consumer reacts to certain changes. And so you need the advice on the board, right? You don't have all these people on the board, but you only have people whose first interest is financial gains. It means that one, they might have a lot of blind spots when it comes to taking care of consumers. Not intentional, because everybody really wants the money and they want to make the business produce a lot of money or churn in a lot of money, but because they have a lot of blind spots in that area, gradually you lose your consumers. And what happens in a few years? I mean, the business goes down and you can't do anything about it. Maybe you have to start another one, picking up from your lessons or something. But usually this is the case, that it's very common. And we have a lot of fights we have to settle. Some goes to court, others, the company secretary, we bear the cost. We have to find a way to sort of restructure the board. Sometimes we have clients come to us and they already have such challenges, and we have to find a way to do board setup and all of that for them. Trying to now have constitutions or board charters or policies in place, all these elements, and to make sure that it works for them. But from my experience, back to your question, this has really been the common mistake, or what is really wrong with companies in Ghana.
Oh, see. You said everything I needed to hear, and I hope you are listening, because I don't want to give too much away because we have the question and answer section next week, but there's those situations where somebody wants to start a business, maybe like you said, let me use a fintech example. They're a financial person, they're a chartered accountant, and they want to do a fintech. They have an idea, but they can't do the tech part, right? So they go and get a software developer, and instead of paying the software developer his money, they offer him shares. You don't know this person and how they react when money is involved. And then the negative part comes when one person is the one funding the business and the other person is sort of, they have shares because they have sweat equity. And there's no definition of what the sweat actually is and what happens when we need to recapitalize and all. Let me not become technical, but these are some of the things that I'm very glad you mentioned, those three scenarios, because accountability is important and separation of roles. Oh, it's very, very important for all of us. Please. If we are starting a separate the roles. But the question I would like to ask is, how do we set up the board? Is there any guidelines in terms of board setup, like any specific rules that you would need on a board that people should look out for when they set up a board?
Yeah. So I'll try to generalize it in answering this: pre-incorporation, post-incorporation, generally when you are trying to set up a board, a 2-member or 5-member, any member board. First, you have to go by what the Act says. So the Act actually has a criteria. for who can be a director, the Act will tell you that the person must not have been found liable in the past 5 years for any insolvency or anything of the sort. The person must be of sound mind. The person must be 18 years and above, and a host of other things that you're expected to go by. So that's the basic thing. Aside that, we have other governance codes. For instance, Ghana just launched its corporate governance code December last year, and it will sort of advise you the kind of people you should have on your board. You should look at independent directors, executive directors, non-executive directors. I don't know if I'm allowed to explain that now.
Please do. Please do.
So now your executive directors would typically be your chief executive, and they are part of the day-to-day activities of the company. So probably the senior most person in the organization or the company is your executive director. There could be one or more, but usually like that. Now there is also the non-independent, non-executive director. The non-executive director could be independent or non-independent. Non-executive basically means they are not part of the day-to-day activities of the business. Independent, we have different ways that codes define them, but all in all, it means that they should not have any relation whatsoever to do with the company or the founders, the shareholders of the company, the directors of the company, no pre-existing relationship, whatsoever the relationship could be a corporate relationship or whatever. There shouldn't be that. And there is also the non-independent and non-execs. Those are probably related to, they are probably nomination directors, maybe a shareholder nominated to have that director sit on the board. And so there's a pre-existing relationship, or there's some sort of outside relationship with a shareholder, and then they're on the board. So these typically make up the board. And then of course there's a company secretary or your governance advisor. Usually that's what the role we play as well. What was your question again, Ellie?
You've answered the question. What type of roles and persons are required on the board?
Yes, so basically, yes. And then all of these people that you pick, it's very important that they know about the kind of business. I think that's what I was trying to get to, that you're trying to do. That's very important. They have the technical know-how or the different aspects of the business based on past experience. If back to fintech, financial person, tech person, somebody HR, if your business is HR focused, lawyer, if your company has a lot of legal matters you'd want to address. So all of these people, but you just pick and choose what really your company needs, the kind of foresights your company needs, and then you get these individuals. They have the expertise and they also fulfill the requirements of the Act and then the governance codes.
Okay. When you look at typical boards from where you sit, what are the roles that people technically forget to include on boards?
I think that the independence, which is very important, sadly, the independence, this is probably the first time this is dawning at me this much. Wow, the independent. Yes, go you. The independent directors, because for instance, for boards that have been in existence for a very long time, the SEC governance code, for instance, will tell you that after 9 years, or even the Kin 4, which is also an international governance code, will tell you that after 9 years, these people lose their independence, right? And you have people who have been on boards for 14 years, 10 years and more. They have formed that kind of relationship with the board to the extent that now it's home, if I should call it. There's no more independence. There are also those that they are related, how family and friends come to play a lot in our local businesses. They are related to the company or to the founder or to the shareholder in a lot of ways. And so the independence really is it for me. I think it's missing, and it's very important because the person is able to bring in a new perspective to the board, which wasn't pre-existing. The person is also able to see things from another point of view, an independent point of view. So it's very, very important.
Why do people use minority shareholders even majority shareholders as board secretary?
Because they think that it's an easy to do job, or they don't quite see the value, if I should say. Now, that's one thing. Also, the other thing is that prior to the enactment of Act 992, which is the New Companies Act, just enacted in 2019, the secretary role generally, I mean, there's this misconception it's about you're just writing and taking notes. It's seen as a very casual task, But now the company secretary actually defines who could be a company secretary. The Companies Act defines who can be a company secretary. The person must either be an accountant, the person must either be a lawyer, the person must either be qualified by the international body ICSA. So the person must be a governance professional or understands the governance profession. In that, the company secretary now has to understand. The thing about company secretaries is that you have to understand tax, you have to understand audit, you have to understand accounting, you have to understand everything, not just shallow knowledge, but everything, because if not, you would not be able to provide proper governance advice, right? So all of these things are needed, but people are yet to know that or understand that or appreciate that. It's one of them. But they don't see that yet. I mean, I'm sure we'll get there. For now, they just feel that come and take minutes. So rather than pay somebody to do so or appoint somebody to do so, they would let a shareholder do it. Before now, people were actually bringing in family members. They'll just write the person's name there when they're incorporating that this is the secretary. After all, she can sit during our meetings and take notes. But now they are trying to push in their shareholders if the shareholder has any of these professions I've mentioned. If you don't have anybody who has that, then I'm sorry, you'd have to come and hire me.
Good question. Why is it that people don't know where to get company secretaries? Because traditionally, for those who know, they lean towards legal firms, to get company secretaries. But even not all lawyers can be company secretaries. So where or why are we not abreast with the different types of firms that offer company secretarial services? If they have a sort of database, where can we find this database?
Ellie, I think the very common database would be LinkedIn, if I should call it database. I mean, if you're a business owner, let me tell you this now. Drum roll, if you're a business owner and you're not maximizing your LinkedIn, you're missing out on a lot of things. You can actually just go to your search bar on LinkedIn and type company secretary in Ghana. You'll find company secretaries. There are firms offering that service, there are individuals offering that service, and there are a lot. Google may help you, but because of how wide the search range is, it'll be difficult to find somebody easily. But on LinkedIn, just hashtag company secretary in Ghana or hashtag company secretary or just company secretary in Ghana, a lot of them will show up, and then you can easily contact them on LinkedIn and send a message, or if the person has his or her email app, you can reach out to them. So there are lots, they are quite there, and you just have to find them mainly through LinkedIn.
Okay. So I'm going to jump right back into what entrepreneurs want to see. We've given you all the gist in terms of the setup of the business, the setup of the board, what the board is supposed to do, who you're supposed to have on the board, what your company secretary is supposed to do. Come on. Before I go into solutions, which is the third week, let me go back into what is wrong and ask some more questions. So, for instance, I know I have done it in the past where I've set up a business. I'm 100% shareholder. I am board chairman. I am managing director. I don't have a CEO. I have not even employed one employee yet, but it's a business. It's incorporated. Owner of everything and the runner of everything.
Yeah.
When you're trying to transition from this, so let's say you've done this, it might be a service for in my case, it was a services business. I was offering consulting services. I didn't need anybody else. Everything was outsourced. So obviously, yes. But like you said, there was no accountability, right? So if you're not hitting targets and goals, nobody's come to shout at me. It's my own business. I quickly realized that I needed somebody to shout at me, so I changed it. But
which is very important, right? We shy away from it, but we all need somebody to shout at us once in a while. I mean, individuals have mentors and co-advisors, personal advisors, and mother figure, father figure. So your business needs that. And in the beginning, you recall I said that the business is now an individual on its own, and that's how the law sees it. So give your individual parents of a sort by giving your individual boards.
Exactly. Yeah. So, for instance, you're in this situation. What are the things that can go wrong if you stay in this situation for too long? That is, only shareholder, board chairman, CEO, MD, and the rest of the business, just everything depends on you. What are the things that can go wrong? Let's not address how to solve them, but what can go wrong?
I jump straight at this. I don't know if your business is still in existence or you've gotten a proper board now.
Proper now. Yes.
Okay, great, Ellie. Because most likely it would have gone down the drain. If there is no accountability and your figures are not right or you're not hitting targets, and this goes on consistently, I mean, you don't need rocket science to tell you that, hey, your business is coming to an end. You don't have people to advise you. And also back to the company secretary question, your company secretary is the eyes, the ears, the nose, basically the senses of the board. If you're a business owner, you have to know that you are in a relationship with regulators, and it's your company secretary who will tell you what the moves of your regulators are, what move they are making next, or what you should expect, or what's new. If you do not have all these in place and you have a business and you have regulators and things are going on, it means that everything else is leaving you behind. You yourself, you're not meeting your target. There is no accountability. There is no transparency. You're not taking the consents of other stakeholders into play in decision making. The decision making process is flawed. Everything is wrong here. I mean, as I've mentioned, transparency, decision making, business regulator relationships, everything, nothing is actually working. And then you're not also meeting the needs of your consumers or really solving the problems you're supposed to solve adequately, then of course, I mean, it's most likely you won't survive it until you change the way things are.
You heard it here. She did not miss any words. Nothing she said that was wrong. In fact, nothing she said that was a half truth. Everything was the whole truth. Because I tell you, if I tell you that I had to write to GRA to suspend the business because I was not on it. And unfortunately, it was also a side hustle. So imagine you have a full-time and this is a side hustle, and then you don't even have anybody that is checking your back or counting you for results. Yeah, I went through that. I admit wholeheartedly, I did it. It was wrong. I've learned my lesson. So we have about 20 minutes. And I don't have any more questions. So I'm going to leave the floor for you. And there's no questions in the chat box, but I'm going to leave the floor for you that if, for instance, you were at a conference seminar and there is different types of entrepreneurs available. We have the sole proprietorships that have the enterprises that they're running. They're basically offering quick services or selling goods. And then we have limited liability businesses, startups, either in any of these startups, they are in year 1, year 2, year 3, year 5. They're still startups at this point because revenue hasn't grown yet. And then we have SMEs who are a little bit established, and they might even have some sort of board, but it's they don't meet that often, and there's one shareholder that runs everything. If you have this mix of people in the room, and let's just even say you have people who are doing it right, they have a board, they have advisory board, they have the main board, they have board committees, and they have all these other things. What would be your advice to this room? You were there as a company secretary and governance expert, and you were there to give advice to all these people on what they can be doing wrong in their governance structure that is affecting their business's ability to succeed. What would you say?
Okay, so many answers to this question, and I'm trying to make sure I cover it all. The first thing is that we all have to know that corporate governance is not set in stone. in as much as the law has its requirements, the law's requirements are actually very basic so that everybody is able to comply with it. So they can tell you basically that your director shouldn't be less than 18 years old, should be of sound mind, which are all basic things, So the law is sort of an open umbrella trying to allow everybody in. So that first should let you know that it is not set in stone. Secondly, the courts give us guidelines so they are very wide scope. They do not force anything down your throat. So this is my first advice, is that structure your governance in a way that the company can handle. Every company at its stage has its own governance setup. Don't think that because they say corporate governance you have to have 2 board meetings or AGM or blah, blah, blah. So it's like you're already scared from the onset, right? And I think that that's actually the reason a lot of business owners start off as sole proprietors, because they feel like, what, especially for you, I think you actually did well, to have a side hustle that was an incorporated entity, because many people would easily go for sole proprietorship. But even as a sole proprietor, there's a way you can have a board, in as much as it's not required by the law. Governance codes give guidelines and advice for that. So now I'll quickly go over an advisory board, right? So there's a difference between board of directors and then the advisory board. The advisory board is informal, as in there is no legal liability. Unlike the board of directors, where if anything goes wrong with the company, you're to blame, you're taken to court, what's not. But with the advisory board, it's your own set of just trusted people. But in order to make it more formal, you can say that, oh, Mr. A, Miss B, Miss C, can we have a meeting to discuss my business? Then you appoint a company secretary. Now, the importance of corporate governance really is to practice and implement it. It's not having just the structure sitting down, names. Yes, I have board of directors, but there is no meeting. They don't know what's going on with the business. You just needed names to fill in your form when you're incorporating, right? That's not what I'm talking about. That's absolutely not what I'm talking about. But simplify the structure such that you can practice corporate governance, because mind you, you're building a culture here and you're not rushing it. So if you're a sole proprietor, you can start with an advisory board. Informal, just doesn't mean that there is no legal liability attached to it. So it's informal, but there are consistent meetings. You have a company secretary, and there are people who actually offer such services to sole proprietors at a very low or sometimes no cost, just because they are passionate about what they do. So they will assist you through and through. When it gets to a point where you want to change over to become incorporated because you feel that now you have trusted people to sit on the board, you can do so. There is a process, legal process. You go through, now you become incorporated. You already have your sort of pre-board even before you went into incorporation. So you put them down and you have already been, that's a good thing when you start early and you start well, you've already been practicing this, right? So when you see board meetings like, oh, I do this 4 times, sorry, the law is even too low for me, right? So you know that you do all your filings and now you have a company secretary who's a professional and knows what to do. This is the kind of business you see 20 years later, and you travel maybe to the UK and they are mentioning this business, then it's back home from Ghana, right? But because they started right, they have the right culture. They've set the right tone at the top. So management is doing well. Now, when you pass the advisory, you have your board in place. The law will say that you have 2 to 5, or well, minimum of 2. You can limit it at 5 or you can go, but they advise that you don't go beyond 7, so you don't want too many people and too many voices. So you go through all the stages, you get to a point where your company is large enough to even have sub-board committees, right? So there's also that. And the sub-board committees focus on the different aspects of the company. So there's audit and risk. There is, audit, risk, finance together sometimes, or compliance is together. There is the HR committee. Mainly these are the committees, and depending on what you do, you can have all the subcommittees that attend to all these needs of the company and report to the board. So the committees is made up of the board member and then management as well. You get to a point where beyond your board charter, because you'll be going for funding in the near future, you're looking at having certain policies like gender and diversity policy. You're looking at having a succession plan, which is very important because you need to start grooming who will take over certain roles at that point. When your independent director gets to a point where the person's no longer independent, you quickly shift them to non-independent, non-executives. And the growth is actually so beautiful when you present this to somebody or to apply for a grant. I don't know why they won't go for you, because they have seen the stages you have been through and they appreciate it. And that's what a lot of people miss out on, because they feel that when I'm going for a grant this year, let me quickly put something in place. Just come, let's sit on the board. I tell you, you will be researched into 2 years, 5 years, 10 years ago and realize that, no, we can't really trust this, because a few years down the line, there was non-compliance on this matter and that matter, and you can't answer to it. Meanwhile, because you probably didn't know, and you probably didn't have your company secretary who is your census of the board. So there's all of that. But I hope I've answered your question. I hope I've advised my wide range of companies and businesses.
You have. And somehow, now that we have 7 minutes left, Richmond wants to ask 3 questions. Richmond, why? Richmond, why? Richmond, thank you. I appreciate the question. The first one was, Richmond, this one, you can watch it in the rerun. It says to quickly go over the components of the board of directors. That's the first one. And then the second one was he was making... I think he was summarizing something you said. He says, so it means that the sole proprietor should start with a board of advisors before they can get the board of directors. I don't think that's what she said, but she'll clarify. And then the last one, or the second one, he says, is at what point should a person move from board of advisors to board of directors? I think still referring to the sole proprietors.
Yeah. So what I was trying to say with the advisory board and then the actual board of directors is, now, when you're incorporated, you're expected to have board of directors. The law requires that. So the law is not looking at having an advisory board. It doesn't work like that. So you have to make sure that you have your board and they are working. Right. Now, the advisory board is advised for, in as much as it's not required by law, mind you, it's advised for sole proprietors. Because definitely you have a business ongoing and you want strategic leadership for the business and guidance for the business. So you set up an informal board. They don't have any legal obligations because it's not required by law. I don't know if there could be an agreement between the individuals. We'd have to look into that further. But generally, sole proprietors are advised to have the advisory board until they are able to transition, or they want to transition to incorporated companies. You have to go through a legal process, cancel the business name, incorporate, all of that. It's not for here. And then if you want to have the same individuals move on, you file them as your directors, and then you have your actual directors also, and you continue your meetings as required. This time it is required, but prior to this, it wasn't required. I hope it's clearer.
I believe so. So I have one question that we did a recap. For oil and gas, my regulator is the National Petroleum Authority. For businesses in general, who is your direct regulator? Who are you dealing with for incorporation, filings, and all those things?
So great. So what we used to call the Registrar General's Department, RGD, is now the Office of the Registrar of Companies.
Okay.
Right. So now our new regulator for all businesses incorporated in Ghana is the Office of the Registrar of Companies. Now they have to just do with your businesses and nothing. So where you have any amendments, like I said, back to company secretary, you need company secretary to guide you on this, whether it's been a change of director, where increasing stated capital, share structure changes, all the changes, even when you change your location, you're no longer working from East Legon, your office is now in Adrian Ghana. Everything has to be filed with the RGD, your annual returns, all of that. So, now ORC, Office of the Registrar of Companies.
Okay. So, we have a little bit over 5 minutes left, and we're going to do a recap of what is wrong. We started the conversation on even what is business in Ghana and what types of businesses are available in Ghana. And then we moved on to how do you set up these types of businesses in Ghana? And then we went on to the governance structures, initial governance structures of these businesses. We've come to understand that we have the sole proprietorships that enable one individual to set up a business name, and the business is tied to the person of this business. We've come to understand that this person is not required to have a board of directors, but if they want, they can have an advisory board if they want that, second eye, somebody to overlook what they do. We've also come to understand that when it comes to limited liability businesses, the business is not you. It's another thing altogether by itself, and it needs guidance and direction. And to enable you to have accountability, you are supposed to have a board of directors, which is required by law, minimum of 2, maximum of 7, which is advised. And then when you have these things in place, you must have somebody who understands what business management in terms of the register or the law, the act is, and that most likely is your company secretary. And you need to have that person in your business if you're a limited liability business, and you need to take advice from that person so that they can help you to ensure that your business is in the right order. We've gone through the different types of scenarios where businesses have got it wrong, where we have shareholder, director, executive directors, general management, all in a person or 2 people, where we've had husband and wife sort of businesses, where she gave another example of majority minority shareholder, where we have CEO, COO, but they are all shareholders and board members and executive directors. So we had these examples, and from all that we've discussed today, we found out that the lack of company secretaries in limited liability businesses is a big problem in Ghana, because the businesses are not getting the right advice on how to manage their governance properly. We found out that a lack of knowledge in terms of what is required when it comes to setting up of boards and how boards are run is a big problem in Ghana when it comes to managing businesses, and also the fact that it will also be a problem when you are looking for external funding, because people need to be able to trust you and your board that you're able to stick to plans, and it's not something you can do in 6 months. You know what I'm saying? And then lastly, we were able to find out that you can find company secretaries, and LinkedIn is your best friend. Next week, please, all the questions you had, Richmond, thank you for sharing the questions with us today, but go and watch this again and gather all the questions from your personal experiences. I shared mine with you. Nobody's perfect when it comes to company management, because it seems like a lot of work, right? It seems like a lot of work, and then it also seems like it's expensive to get other people in the business, because nobody's time is for free. But it's also, I can tell you from personal experience, it's even more expensive not to do these things, right? The money you'll lose, it's better you don't start the business. Don't do it until you're ready. But get all your questions together. Next week is going to be rapid fire questions. We're not even going to let her tell us what is wrong. We're just going to be asking her all the questions that she would have charged us for. We're going to ask it for free. Make sure you have questions ready. And then we'll answer that next week. And the final session, if you don't want to do the question and answer, the final session, which is the summary and the advice, the proper advice, is going to be in the 3rd week, where we're going to take all of it from Lovetta. And I think that'll be on the 31st. We're going to take all of this from her, and she's going to give us the updates on what to do when you're setting up a business properly, how to set it up properly with all the structures, who's supposed to be on your board, and all of this other stuff. So as I'm rounding up and I'm jetting off and I'm letting Lovetta go before you go squeeze the life out of her, thank you so much for joining us today and for being so insightful. It was such a great conversation. The questions were just running out of me, and we were out of questions in like 30 minutes. The kind of people I want to be talking to. And Richmond, thank you for being so engaging. Anna Sapeng, thank you for being so engaging. Everybody that was engaging, thank you so much. And Lovetta, I'll see you next week.
Sure.
Is Kofi around, or does he want to say a few words, or that is he's left me to myself? And it's like he's left me to myself. Okay, big man. Thank you so much, guys. Until next week, it's been PBI. And we'll catch you same time next week. Same Same Zoom details. Don't miss it with Loretta Juman. Okay, guys.
Thank you. Thanks. Bye, everyone.